see. Are you the host, Dan?
I am. I have a recording going right now.
Do you see an option to give me permission to record?
It only gives me an option to record to the local computer or to the cloud.
Yes, I guess you may have to send me the recording.
Happy to do it. I can put it in a cloud drive so that you can access it.
Okay. If you, and I'm sorry to do this, but it might just to on the back end, it might make it simpler. If you click on my name and participants and maybe press more, does it give an option of granting permission to record?
Yes. How's that?
This will just make it a little simpler on the back end. Sorry for that. Okay, I'm recording on this end. Okay. Thank y'all all so much for gathering here.
Thank you for teaching me a new technique in Zoom.
I learned a lot about 2.0 and its impacts in the last couple of weeks. And one thing a few people have told me is the impact that it's going to have on people, home builders and people who want to build homes without much to go on as to, you know, should you raise it this many feet? What if it turns out that it needs to be this many feet and a couple inches? Just kind of the difficulty that you're faced with there. But if anybody wants to kind of, I'll let you take the floor and if you don't mind, just hitting kind of the main concern for this industry and then we'll go from there if that's okay.
Well, Ms. Lane, if you don't mind, I'll start with a statement and then introduce our guests, and then we can open it up to questions on the points. How does that sound?
That sounds great.
Okay, I'll get started with that then. Part of the core mission of the Home Builders Association is to provide quality, affordable housing. FEMA 2.0 is dramatically increasing rates in our region in unprecedented ways. Our initial review identified 4 major concerns: renewing policies in our region, or losing flood insurance subsidies we have worked to earn over decades. Number 2, new policies in our region are being written at a full rate without regard to flood zones. Number 3, as home builders, we cannot access rate information necessary for cost-benefit analysis. And finally, homeowners are obligated to, quote, obtain and maintain, unquote, flood insurance for homes already mitigated in partnership with FEMA and must also pay rising premiums. All of this means affordable housing will be increasingly unattainable in our communities. So we have here today several stakeholders that can discuss these concerns, including Linda Nugent-Smith with Keller Williams Realty, Bruce Leyburn with JBL Properties, and my name is Dan Mills, the CEO of the Home Builders Association of Greater New Orleans.
Got it. Thank you so much. And what, I guess maybe for you, Bruce, what's kind of the conversation that you're having with people who are approaching you about wanting to build homes? What is the difficulty that you're having communicating sort of the unknowns there?
Well, great question. I first have to say that we're a developer builder. In my business, we do build in 3 states. 2 of them are not in the floodplain, but Louisiana is where we build here, and the bulk of our holdings and activity every year for for 30 years has basically been South Louisiana. Since we're a developer builder, we acquire land. What we have done in the past, we acquire high land in our region. We then fill it, typically, elevate it with fill, and obtain what's called a LOMA. So it gets classified, if it's not already in the X zone, what we build on is all X zone property. And that's a big difference because X zone properties have in the past enjoyed a much lower rate. Today, under risk rating 2.0, they do not have that much better rate any longer. What they do have still is, by statute, they're allowed still today the option of whether they will purchase flood insurance or not. And across the board and across the country, from the Zoom conferences we've been in, we're hearing that when the option is offered to not purchase flood insurance at the higher rates, that's basically what people are doing. And that has been my experience.
To speak to that, if you look at FEMA's website, they acknowledge that up to 20% of policyholders will drop their policies based on what they're saying on their risk rating 2.0 website. And that's in anticipation of X zone policyholders that may withdraw from the NFIP.
What does that, what's sort of the overall risk there? Or if there is another sort of Katrina or Ida, or another major disaster that's unexpected, where 20% of people who may have a plan now decide to drop it?
Recording in progress.
Well, the risk is if a property owner decides not to purchase flood insurance, they're of course not covered. They can choose still choose in the X zone to be self-insured, but they would not be covered by the flood insurance program. This is a very bad thing. It's not good. In our region where we live, we still live in a flood-prone region, and it is susceptible to major storms, as we've seen for the last several years. Katrina is a big one. Ida has certainly been a big one closer to New Orleans.
Got it.
Linda, I think you're on mute.
Thank you. In effect, zones are going away. I directly asked that question and I was told yes. That zones. What is that feedback?
I think
Is anyone else hearing feedback?
Yes, I think maybe if the rest of us mute, then that can avoid the feedback.
So with those zones going away, it's unknown looking into the future how they're going to determine where, at what height you have to build a house. They don't want fill under houses. It looks like they're headed to wanting most houses raised, but there's no indication as to how high, and the guidelines for that the insurance people have to fill out are so subjective that no one really knows. I've had on existing houses, I've had 3 different quotes on the same house from 3 different insurance people, and they've all been different. So how is that possible? There's no rhyme, no reason to what's going on. Because for one thing, on October 1st, it came into effect, and there was no warning as to what was going to happen on October 1st. There's also no real warning on what's going to happen on April 1st, because that's when everybody's rates, your existing rate, my existing rate, will, and I say that on the renewal rate, which starts April 1st, you're going to start seeing rates going up, and that's when people are going to start getting alarmed as to what's going on. They'll go up 18%. on April, starting April the 1st, whenever your renewal date is after April 1st.
Got it. Except I guess for people who are building homes or buying new homes without a policy, is that something that any of you are finding that customers are being surprised about and having to reprioritize or rethink their plans? Maybe because they don't know, how much they should elevate their home or what they can afford.
Well, Bruce, as he said, Bill's only in X zone. So as of right now, he's not having a problem. When they do away with zones, who's going to know what problems there are? We don't know what we don't know yet.
And in my case, which this is Frank Morris, in my case, yes, people are starting to question whether or not the location that they have, and I do build in all zones, the zones that are current at any rate.
Right.
And they are starting to question whether or not they're making a correct decision and whether they were going to suggest that they locate their home. So yes, it is a question.
But there are a lot of questions, but there don't seem to be a lot of answers.
Right.
I did see the letter that Senator Cassidy and some others sent to FEMA asking for more clarity on what makes up this sort of algorithm. How would that be helpful to people in your industries if you knew what factors exactly, not just what you've been told so far, but what factors exactly went in to this formula?
We know the factors. What we don't know is the weighting of each factor. So we know that they would prefer houses to be raised. We know that if you build with a masonry product rather than a stick-built product, that you get, a better rate. We know a lot of answers, but we don't know what weight they're giving to be able to come up with a final outcome on a premium.
So one of our core concerns is that we are unable to do cost benefit analysis because we don't have access to those rates. So if we want to offer to a homeowner the opportunity to raise their home, we know how much extra it will cost to raise that home, but we have no way to calculate what savings may be involved for their flood insurance if we perform that extra cost, in raising that home. So we're not able to evaluate the value of the flood mitigation. We want to provide additional flood mitigation, but we don't know how to do that cost benefit analysis because we don't have that rates. Bruce, this is a big area for you.
If I could, I'd like to interject this. It is not just new construction.
Right.
Hundreds of cases in point right now in our region in hurricane recovery. We have homes that are substantially damaged. That's a term in the code. Substantial damage means that you will be doing major improvements, might include structural improvements. And you're required to bring the home to the modern code, which includes flood insurance guidance. We don't have very good guidance. When we start these projects, the only way we're going to find out what did we save or what did we spend on flood insurance is when we complete the home and get the insurance quote. It's just wrong. We should be told how to do it correctly up front, not at the tail end. We should be told up front how to do it correctly. That is not happening.
And if a house is not in the X zone, if it's in an AE zone, and you're going to improve it more than 50% of its value because of the damage that was done and the work that's now required to be done, you're going to be required by FEMA to obtain and maintain insurance for the life of the house. So even if you sell the house, whoever buys it agrees to obtain and maintain without knowing what that number is.
Yes. And hence the affordability problem, which is a very critical factor.
Something that came up in a meeting that I was in last week with the head of FEMA was that I learned was that a house 600,000 and above has a cap of $12,125. That's what they're suggesting. And our question was, well, if you can have a cap on the upper end houses, why can't you have a layered cap for different price ranges to where the effect, 12,000, there are people who are paying, you know, $40,000, $50,000 in some of these houses on water in some parts of the country. So they wanted to cap it to where those ridiculous numbers weren't in existence, which I think is a good idea. But when you take an affordable house and you raise a rate from potentially $572, which is a subsidized rate, you get rid of the subsidy and you have to go up to the actual full premium rate. It can go up, you know, up as far as they want for it to go up to the 12,125. There should be a layering between that to where a less expensive house has a cap that's more reasonable than that.
Given all this, what do you think, any of you, is the potential impact on development in this region?
It's another question that remains to be answered because I mean, they're just not giving any real, not even to our floodplain manager. We've talked to her a number of times and she's very good, but she's got questions and has not been able to get answers to be able to give the guidance that's needed for people to make these probably the biggest investment in their life, that those kinds of decisions.
And if I could, I'd like to talk a little bit about the guidance. For 50 years, there's been a flood insurance program in this country. 30 years, they started a program that recognizes when FEMA started a program 30 years ago. It's called the CRS program. When they started that, they started training communities how to make their homes and their communities more resilient. And they rewarded that. When the communities followed the FEMA guidance, they rewarded it with a discount. That's called the Community Rating System Discount. Jefferson Parish has worked very hard for 30 years to achieve a 25% discount. That is now gone under the new FEMA 2.0 until, except for those properties, only until, and except for those that are paying full risk rate already, like a new home would pay. In other words, all of the renewal policies. In Jefferson Parish, there's well over 100,000 flood insured properties that enjoyed a 25% discount until October of this year. And now they will no longer have that until they ascend to the full risk rate, which will take 8 to 10 years at 18% per year increase.
Compounded.
Yeah.
Right, that increase is like a balloon payment because 18% of your premium now, but next year your premium will be substantially higher. So then you get 18% of that. So the increase each year is more and more until you get to that actuarial rate. We had a group here 2 weeks ago that included interests from banking and mortgage and development and building. And one of the guests was GNO Inc. They provided some specific examples, and I can give you a couple here. One in Belchase, a home with a replacement cost of $393,000, square footage of 3,000 feet, currently has a premium of $572. They're going to increase by 18% until they reach the new actuarial rate, and that's going to be $8,828 annual premium. That's a 1,400% increase in premium for this home in Belchase. Another one in Thibodaux. This is a $132,000 home. It's 1,000 square feet, $572 premium. Under 2.0, the new full premium will be $2,217 or a 286% increase. So think about the affordability. Someone's living in a $130,000 home, making a mortgage payment, and now their flood insurance is going to progressively increase from what was less than $50 a month to in the neighborhood of $200 a month. So this is a significant impact. And for new sales, that will be a big issue. We have many homes in Terrytown and in other parts of our metropolitan region, not just outside of the metropolitan region, that are going to be vastly impacted in the affordability And mortgage qualification for these homes is going to be very challenging for many individuals. NOLA Lending has found that some of their pre-qualifications for new homes are having to be reevaluated and in some cases canceled because they qualified the buyer in September. And now it's October, and the new FEMA rates for new construction went into effect October 1st. And now they're finding that the insurance rate is raising their monthly note by maybe $200, and they no longer qualify for the financing. And so NOLA Lending, which is a part of Fidelity, has now, they're looking at multiple contracts that will have to be canceled because the buyers simply don't qualify anymore. So it certainly could have a chilling effect and is a big concern, not only for the mortgage lenders, but for the bankers that hold the current mortgages, for those like this individual in Thibodaux that are going to be facing higher and higher flood insurance premiums. That escrow payment is going to increase year after year, and it could potentially price individuals out of their home.
I heard that from somebody else that I talked to about this, that the banks are going to have to start weighing and considering this, but it sounds like they already have from what you're telling me.
We're seeing examples like this percolate through our conversations, but we don't have access to these rates. So it's very challenging for us to determine, again, the cost benefit analysis and what the broad-based impact is going to be. But the GNO Inc. did some studies in association with the Coalition for Sustainable Flood Insurance, and they found substantial increases, of course, in our local area, but also throughout the state, throughout the Gulf Coast, and even up the East Coast, finding rates in New Jersey that could increase by 400% under the new rating system.
Just as a side, Robert Taylor, who was at the meeting that Dan and Linda mentioned with Senator Cassidy, wrote an article in the Advocate yesterday, if you want to look that up, directly about this exact problem as it relates to the banking industry as a whole. But and everybody said it from the get-go. This is a very, very serious consequence for affordable housing throughout, because even raising the elevation 1 foot, which we're not saying don't do that, but at $5,000 knocks many people out of qualifying for that loan. There's a lot of issues here.
What we're asking for, because they say they're trying to be, quote, equitable, because there are people in other parts of the country that feel like they've been subsidizing, and that's why it's called subsidy. They have been subsidizing our rates through the federal government. The government, FEMA has lost $1.4 billion a year for the last several years. So the Congress has come back and said, hey guys, you got to do something about this. So we understand the problem and we want to be part of the solution, but we do not want to be it to be so punitive on people that they can't afford to live in their own houses. So there's got to be a layering, or they're calling it a glide to your full rate. And that glide can take just a few years, or it could take many years, but it still doesn't take away the fact that people who can't afford that ultimate number still can't afford their house. And a lot of them won't be able to sell the house, because if the rate is high, I have a little house in Tarrytown right now that they're paying around $1,400. Theirs is going to go up to over $4,000. You go from that to that, and all of a sudden, and I'm talking $160,000 house here. We had a house, we have a nonprofit called Noel that does work with the parish in trying to help with affordable housing issues. And we were given some money to be able to do both a new house, which we did. I haven't even checked on what that rate's going to go to, which I probably need to. And the next one was to buy a house, renovate it, and be able to show the neighborhood what you can do if you really want to make your house look more updated. A neighborhood improvement project is really what it is. And we had a house offered to us that's going through foreclosure right now. And when the rate came back, because of course they have, if you're in foreclosure, you haven't been paying your flood insurance, right? You haven't been paying anything. So all of a sudden it goes to the full rate because there is no existing rate that can be assumed, right? So I got an estimate on that, and it's over a little over $3,000. Well, in an affordable house project in Terrytown, you can't sell a house that's going to have $300 and some odd a month flood insurance premium, plus your homeowners, plus whatever your mortgage is going to be. How affordable is that?
And y'all are, obviously this group is in touch with the powers that be. Have you received any information that guidance is coming down the pike?
Well, according to the head of FEMA, it's already gone down the pike to the insurance agents, and they just need to do a better job of reading the material and applying it to the guidelines. That's as of last week. That was the answer.
So there's so you don't expect necessarily, unless there's some sort of shift, to have more, I mean, transparency is what Senator Cassidy was calling for with these guidelines, and like you're saying, how they're weighted.
That's right. We know what the considerations are, but if you don't know how to apply those considerations either to an existing house or to one that you want to build, it's of no real value to you. You can't do, as Bruce says, you can't do a cost benefit analysis.
In legacy FEMA, we were taught for 30 years, we were trained very well as builders and as communities who participate in the program. We were taught by the FEMA program how to do a good job. And as builders, you learn that if you don't have to do too many, and you start to learn, well, you elevate the home another foot or two and you save the homeowner $1,500 a year in premium, and you pay back for the cost of elevating the home a little bit more. You pay it back in a short number of years. Now, I've done this as a builder under the legacy FEMA. I've done this most of my life. In fact, I can't remember when I didn't do it. But under FEMA 2.0, they do not give us guidance. We do not have the guidance. So we're making decisions without any knowledge. And it's worse, really, when you think about it. I think it's worse for the homes that have been damaged by the disaster, the hurricanes that have hit Louisiana lately. We don't have guidance over how to rebuild. We're just rebuilding without real knowledge. And we hope it'll turn out okay, but we don't know. That's a real tragedy.
Could it push some homeowners out of the region?
Oh, of course.
Yeah.
When you have people who live near the river and they're fishermen and dock workers and people who make a living, but they have a house and all of a sudden their note goes up by $300 a month, they can't afford that in the majority of them. So what are they going to do? They're going to have to move. So where do you get your workers for your economic development issues that you're already dealing?
I was on a workforce call with the Plaquemines Association of Business and Industry, and they were discussing workforce needs. And although they've recently had an announcement of the Phillips 66 closing, they are also anticipating other expansions, and in particular, a new terminal for cargo that they've recently inked a deal on. And attracting affordable housing or providing affordable housing to attract a workforce is exceedingly difficult. Our building costs makes it very difficult to build a new home that can be within the reach of the 30% of average income in our median area. To get to that affordable range, it's very difficult, if maybe impossible, to build a single family home that meets that criterion for our median income in this area. And when we couple to that the increasing costs of not only the supply issues, which hopefully are transitory, but these flood insurance costs, it's going to be crippling and out of reach for the majority of our residents to live in a single family home. And, you know, multifamily is going to face its own set of challenges as well. But it's a real issue, and that workforce group shares many concerns as we discuss the FEMA 2.0 and the risk rating system that they're working through now.
And think about what this may do to rental housing. We've been talking about the 18% for owner-occupied residential properties. When you start talking about apartments, anything over 4 units, and commercial properties, their increase is 25% on a glide to whatever their actuarial rate will be. But people can't eat that. So what are they going to do? They're going to pass it on to the tenants. So what does that do to affordable housing? It is a snowball that's just growing and growing and growing, and nobody seems to be able to figure out when it's going to, you know, when it's going to stop growing.
And we're talking about affordability. It seems that some of these factors we do know about, it helps that it's a 2-story, that it's masonry. Some of those factors I would think cost more to build.
Well, you know, the problem is one part of the government, you know, they're given a mandate to get rid of this $1.4 billion loss every year. You know, a problem, no doubt. Nobody disagrees that that's a number that is it is a big number and that something needs to be done about it. But what one part of the government does to cure their own problem creates another. Nobody looks at the unintended consequences that making decisions, large decisions like this in a vacuum create for everybody else. They're going to solve their problem. So, okay, that solves this problem. Now, how many people are going to be out of a house? How many houses are going to be foreclosed on? You know, these are things that nobody really factored in. All they're thinking about is the people who had these big premiums are going to have a cap now. So they're not going to be paying $38,000, $48,000 a year. They're going to be capped at $12,125. But the other end of the scale is being hurt in proportions like he just described, that they can't afford any more than the guy who has the big house that has the $12,000 premium. It can. So nobody is trying to make sense out of it. It's all about solving a problem, coming up with matrix, and forgetting the human factor. The human factor was never a part of the algorithm.
Got it. That's all the questions I had. Is there anything that anybody else wanted to say, particularly you, Mr. Mills? Or
I do. We have some proposals. I'd like to hit those real fast. We do have suggested solutions. If we can maybe get the attention to this, we have asked for some of this already. Perhaps your news story can help open their ears. We'd like to see national support return and reestablish the discount system that's been in place for over 30 years in this country for the 1,500 qualified communities across America that have earned by hard work for 30 years under close guidance with FEMA. We'd like to see that discount restored. We do not understand why it was suddenly done away with under 2.0. We would like to have permission from FEMA to use their algorithm when we're designing and building, giving for cost benefit analysis. We'd like FEMA to allow us as builders to use their engine, the same engine that the insurance agents are using, so that we can tell our clients how to build safer, more resilient, flood-safe homes at lower premium cost. We can also tell them what it costs, if it's going to be elevate, if it's going to be built on piers off the ground. We can tell them that cost. We need to tell them what the premium savings is. We're asking for keys access to the flood rating engine that FEMA is so proud of with the insurance agents. We'd like to see premium caps restored at on a tiered basis so that the max cap right now is 12,000, as Linda said. We would like to see caps that are more representative across the spectrum of house prices that might, for example, a $300,000 max premium, a house valued at $300,000, the max premium on that should not be $12,000 a year. It should be less than $12,000. We're asking for that. And that we're also asking that the properties that have been elevated by FEMA program, they've been mitigated and elevated because of their repetitive loss, and they've signed agreements that bind their property forever, purchase flood insurance. At the time those agreements were signed and the homes were elevated, they were not told what the premiums would become. Today, they're being told, and it's a huge shock. It is not fair. They should be protected from these harsh rate increases that they're facing. But these are our proposals. They seem logical to us.
And the public is not really aware of a lot of this yet. The thing is, this just went into effect for new policies October the 1st. So until people's policies start renewing after April 1st, say mine, I think renews in September. So I won't know what my rate increase is, my 18% rate increase is going to be until September. I can sit down and figure it out because I too have a $572 a month premium. I'm in an X zone at the highest point in Jefferson Parish. I'm across the street from the levee. If I ever had to call upon my flood policy, everybody behind me is already under 10 feet of water because they're a lot lower than I am. So I am a person who might consider, when my policy goes to 30 some odd $100 a year from 572, and I know I'm higher than everybody else, do I want to keep paying 30 some odd $100 a year forever on this house? Answer is probably no, not with the way it looks right now. And there's a lot of people who won't get that shock value until after their print. Even then, it'll be 18% and they'll grumble. It could, if they don't know to ask what their actuarial rate's going to be at full premium, they'll just keep being surprised every year.
I'd like to take a moment just because maybe we didn't cover clearly what Bruce's fourth point was. Let me give you an example of what that mitigation would be. So take a home in someplace in the city. Let's just say a home in Lakeview, for example, that flooded in the past. They partnered with FEMA to raise that home. Maybe it was a slab home. They raised that home by 3 or 4 feet through shoring. That might have cost maybe $120,000. The homeowner was obligated to cover 20 to 25% of that cost. So they put, say $25,000 into that mitigation cost, and FEMA covered the other 3/4 to raise that home to a level that would sustain them at the most affordable insurance rate. So they get into that 572 rate, right? But now, and in exchange for doing that, they were required to commit to the NFIP in perpetuity. So they have no choice to leave that program. And now they will see those rates increase substantially. In some cases, they could go up by 4-fold, which is a substantial impact. And these are individuals that put money up, that FEMA put up, that they worked together to get this mitigation strategy in place, raised that home, did everything that was involved. And now they're going to face substantially higher costs through this flood program, and that potential was never communicated to them at the time that they engaged in that partnership with FEMA to raise those homes. So that's a really concerning situation that you can see. And Lakeview, those homes are fairly expensive homes in that area. But this is a situation that has occurred all across our region. Maggie Talley spoke about it in Jefferson Parish. She's the floodplain manager, and she indicated that, I believe she said there could be about $10 million of mitigation that was done that could affect hundreds of residents in Jefferson Parish. So this is a big issue in terms of fairness, and so it's something that we're concerned about. But
I'm going to correct you. Much more than 10 or $12 million was spent on these mitigation efforts. What she was alluding to on that is we'll lose 10 to $12 million on premium credits, basically, because they're taking the 25% away just in the first year. So it's a huge issue that people don't even know about yet.
Right.
Yeah, I'd like to echo that. I think in large part, the people that I'm speaking to don't know anything about this. It's not been widely publicized. Many of the insurance agents still don't know.
Right.
In fact, my insurance agent, Allstate, I've been with them a long time. They are having difficulty. She was very kind in the way she presented it, but she's having difficulty with this. The program they're using to pull it up. She hasn't been able to pull up consistently flood insurance rates and new policies. But you know, she's still grasping for answers and a better understanding. But what this really amounts to, an affordability issue. We're going to have a really tough nut to crack here with affordability. People are going to be affected. And, you know, until we get some good answers and some good guidance from FEMA on what, you know, with many of the things that they've told us in the past, it seems that they're throwing out the window. And so to move the football on us now, talk about fairness. Well, that's okay. We just need to know the answers, and we want to get down to the basics so that we can tell everyone how they can afford to live here, and we can move on with our lives and our businesses and our daily goings on.
You think, given those recommendations that you've come up with, I mean, you've got to assume that solvency of the program is part of what's going on here. Do you think if some of those recommendations were taken into account, that more people would continue, you know, people in X zones would continue getting coverage that maybe would stop the, you know, draining the program from losing money from people who just decided to drop their plans?
Well, I don't think they know they're going to drop their plans yet. They haven't gotten there, but I think we've got to come up with solutions to some of these problems, or, you know, get them to open their minds to some other potential solutions, and not just be, this is the way it is, because that's what we're getting right now.
One of the biggest principles to any risk rating, actuarial risk rating pool, is to keep the pool as large as possible. You don't want a small group, and you definitely don't want the group that even today in X zone, they're stated they do not have to purchase flood insurance, but here's your premium, it's $3,000 or $4,000 a year. And most folks in the price ranges I build in so far, all of them have said, no, I'm not going to buy it. So this is the process that Senator Cassidy spoke of. He's the first one I heard use the term adverse selection.
Yes.
Those who don't have to purchase it because they're in the non-flood hazard area are not purchasing it. Those who have to purchase it because they are in the flood hazard area, they have to purchase it, and it's hugely expensive. Now, Emily, I want to invite you to stay tuned in all of this, because one of the hardest things really is to educate the public. They do not know. Brian just talked about that. The people out there do not know about this, and they're not even going to be told until they're going to start to be told in April. And they'll have to pay attention, as Linda said, to their policies when they receive them starting in April. They'll have to read sort of the fine print. It's not hidden, but it's not easily understood either. So I'd like to invite you to stay tuned, stay in touch. You're probably going to have to write about this more than once to get the people educated.
Yeah, I told one of my editors, we're gonna report on this. We're gonna have to be reporting on this. So I think we should probably try to get ahead of it. Because people are gonna start to get really worried about it. We might as well give them a heads up.
Well, they need
And I was
education.
in that camp, I had heard of this, but didn't know much about it. And then it was mentioned on a reporter call with Senator Cassidy's office, and I was listening for something else, and I thought it was alarming, which is why I'm working on the story.
Well, stick with us.
Thank y'all so much. Thanks for your time. Appreciate it.
I'd like
Thank
to
you.
with Bruce also, and thank you for the opportunity to share our thoughts with you so that we can hopefully in some small way contribute to getting factual information out there for consideration by all of the parties involved. The Home Builders Association of Greater New Orleans is focused on providing quality, affordable housing, and this FEMA 2.0 could be one of the most impactful things on housing in our community that's come along in decades. And so it is something that we continue to monitor on a daily basis, continue to invite stakeholders to be a part of, and continue to try to get the word out to everyone that will listen.
I might just add one other thing. One of the things that was brought up at a meeting we had a couple of days ago was the federal government now wants to run this like a real insurance program. The problem with that is that when you have years where there is no major impacts or no flooding hazards, the insurance companies take that money and they invest it and make more money. In this case, from what I understand, the federal government takes the money when there aren't much hazards, too many hazards that they have to pay out. They take that money and they put it in the general funds. So even though they want to run it like the actuarial part of it, like an insurance company, they are not saving those funds and investing those funds to mitigate the costs later on in years when you have bigger hazards and they're paying out more on damages. And so that's where it's completely different. And that's where I think they're losing it. And it's not, you can't run a public fund and flood insurance fund like an insurance corporation if you're not going to take that money and invest it for rainy days when you have years where you have substantially more pay on hazard or damages. That's it.
Good point. And one last comment and question. You mentioned the fishermen deciding, and how much they raise their houses to stay in them, and they might be priced out with their rates. And when you talked about the impact on rentals, it made me think of New Orleans. A lot of that brings to my mind sort of the culture bearers of the region and how they could be affected by this affordability issue. Has that come up in any of y'all's conversations?
Certainly.
Absolutely.
That's what made me mention it. I mean, this thing is so far reaching and people don't know about it yet. So we've got to, there's an education component that has to go on if we're going to get, I can't even say ahead of this thing. We're already behind. I mean, it came into effect October the 1st, but people need to understand the far-reaching consequences of this entire thing.
Yeah, you may not, many may not like the analogy, but we're just in the tunnel right now. We can see the light down there at the end. We're just not sure if that's a good light or it's another train coming at us.
Right.
And we're not there. No one, I mean, we've talked about it, but no one, I don't think many of these people have any clue what that light is at the end of this tunnel.
All FEMA knows is they were asked to not lose $1.4 billion every year. So they went about their merry way of finding out how they could get people to stop, for them to stop subsidizing people, which is part of their loss, and how they could pass that loss on to others. And they've come up with a plan. But we didn't know what that plan was until it went into effect.
Right.
Well, thank you all again. I appreciate your time on this Friday afternoon. And I'm sure we'll be in touch as we learn more, hopefully.
Thank you.
Thanks, Emily.
Thank you, Emily. Have a nice weekend.
Sure thing. And Bruce, I'll make sure to let you know when I know that this is going to run. I don't think it'll be next week. I think maybe the week after that, but I'll give you an air date when I learn of it. I don't know right now.